the issue is, if the inputs to your model can be observed,
that's what I'm talking about.
then it's level 2.
Yeah.
So is it level 2?
It can be observed.
Level 3 because we are not sure about
But hang on. I never said not sure. You're changing the definitions, right? Let's stick to the IFRS definitions, okay? In IFRS, level 2 means the inputs are observed. So, for example, if I want to give a loan to you, and the loan is based on his income, is his income observable? It is? Do you know how much he makes? Can you go look on the internet? Now, if you're a Swedish citizen, if I'm in Sweden, yes. Because in Sweden, you go to the internet, or you can go down to the tax office and say, how much money does this guy make? And they'll tell you. So if you were a Swedish person in Sweden, it's observable, right? But in Pakistan or in America, can you find out how much money he makes? If he doesn't want to tell you, it's none of your business, right? So if he tells me his salary, and I take his tax form, you have 3 income statements, right? The one for tax, the one for the auditors, and the one for the bank. I take all those 3 statements, I average them, and I say, okay, based on this data, I'm going to give him a loan. Is that observable? No. That's level 3. Now, if he's Anglo Fertilizer, and he's on the stock market, his financial statements are in the public domain, it's observable, right? So the key thing about level 2 and level 3 is, can you observe the inputs? Not how crappy the model is or how good the model is. So we have another concept of reliability, which is different. So, no, it has to be the core inputs are observable. So are all of the inputs observable?
Credit risk is the most challenging part of it.
But are all the inputs observable? No. What is not observable? Yeah, but if you were going to do a model to get a value for this,
you can do a reference pointer estimate.
but probably you're missing the point. Probably one of the most important inputs into your model would be Merkel. Merkel made a statement. Is that statement observable? So, is this statement observable? The bank said yes. Is the bank right? Of course it can.
It's not obligatory or nothing. You can't take.
But if you were to, when George Soros and myself bought those bonds, why do we buy them? Because of Merkel. We thought she wouldn't lie. We were wrong. She lied. She's a true politician. But we thought she's different. She's a strong woman. We thought she would be honest. Made a mistake. She lied. Because after she made that statement, 4 months later, they defaulted. The point is, if you were going to build a model to get the value of these bonds, you would probably take into account the fact of, they call it the implicit guarantee of Germany. Because they're in this union, there is political pressure for the neighbors to bail them out. And that is like a credit enhancement. It's a massive credit enhancement. If you compare Greece with Venezuela, Venezuela doesn't have a credit enhancement. Venezuela is toast. Right? There are big problems. So the point is, if you were to do a value of this bond, you wouldn't just look at LIBOR, the credit spread, the traditional metrics. There's another factor here that is significant. And you would have to make your own analysis of how to deal with that. If it's observable, it means you could go to the market and the market would say that is worth 200 basis points reduction of interest rate. It doesn't say that. the statement is observable, but what we talk about from an IFRS 13 point of view, is there a number? What does that statement mean in terms of numbers? So I have LIBOR, I have the credit spread, I have the yield curve. I don't have the credit enhancement spread for Merkle, my own model. I come up with my own assumptions, and that's going to have an effect on the value.
If you are taking that statement into account, all you are doing is you are enhancing the credit spread.
Correct.
Because at the moment the market is anticipating a lower credit spread, a higher credit spread because they are anticipating credit risk to be high. What you are saying is that because of this statement you are reducing the credit risk and reducing that spread. But so that is not observable. You are taking in...
Correct. Therefore it's level 3.
Yeah. Because what I experienced is that was that as far as sovereign risk is concerned...
What risk?
Sovereign risk for a government entity.
In a normal situation.
Yeah. There is very few models or anything available. There is very little guidance available within the IFRS or even in the Big Four literature. Because when sovereign risk is involved, there is no way that you can estimate what will be the credit spread. Because we currently found a situation when there were investments in Yemen. So there was very little guidance available as to how to account for certain risk under IFRS 9 also, or within the Big Four literature.
Yeah.
Ultimately, what I saw was that the assets get impaired, and that moves out from the exchange translation. It affects the exchange, and that's how it flows to the P&L.
That's the same with Syria as well a few years ago.
And the same problem was with Venezuela and Greece also. So,
but the point I'm trying to make is the difference between level 2 and level 3 is not the model, not the output. It's only the inputs. So when you state your core assumptions, if those core assumptions could be corroborated to market data, then it is level 2, period. Irrespective of whether it's a good model or a bad model. If those core assumptions cannot be corroborated to external data that anybody can check, it's level 3.
So can I ask an example?
Yeah.
In the recession time, we were auditing a German bank. Okay, what they did was they said that the prices of they had invested into bonds, and they said that the prices of the bonds are very low because there is no liquidity in the market. Okay, so as a banks association, they came up that we want to adjust the liquidity spread for calculation of the value of the bonds by XX factor. So what they did was they just adjusted the liquidity spread in the market for the market and came up with the valuation of the bond. So in my view, it is a level 2. What would you say?
Well, it was a liquidity spread you came up with. Was that a base?
The market liquidity spread because the market was very low because there was no trading happening in the market. And the reason for no trading was because the market had lost confidence. There was no liquidity in the market. Nobody was willing to put in money. So what they did was they adjusted the liquidity spread.
It can be observed from the historical liquidity curves.
There's no historical liquidity curve available. They are adjusting it because they are saying that the market has just dried up. Nobody is putting in money. Like it happened in the Karachi Stock Exchange in 2008. Nobody was putting in money at all. So there was a liquidity crisis. They just said that this is not reflective of the market. So
it's not orderly.
Liquidity curve. There was no observable data available, but it was an agreement between the banks that locally all the banks had agreed that we will adjust it by this much. So how would you take it? Would you take it as a level 2 or level 3?
Is the information in the public domain about what the banks agreed, or was it privately done behind closed doors? Because in other words, for it to be observable, anybody needs to see that. So if there's a banking institute or there's something published,
all banks are adjusting by the same amount.
And if
in Pakistan, if all the big 4 or 5 banks, they come up that we will adjust it by this much to make it reflective of the market. So sort of for the auditors, it is available in the domain because it comes out that yes, it has been agreed. But there is no, it's not available on a piece of market, but it is sort of...
That's a tricky one. I mean, I'd have to research that a little bit more. My instinct is, if everybody's using the same spread, then that there is a market consensus, then therefore that is observable. Because observable also talks about market consensus. So my instinct is everybody uses the same spread, and there was a market consensus that for liquidity we're going to use 200 basis points, whatever we happen to use, that information is somehow in the public.
But on that, my view, what I feel is that aren't you manipulating what the market is saying? Because the investors, they are not willing to put in money at that point in time. The balance sheet is a point in time snapshot. No? So the investors, they are in a liquidity crisis. They are not willing to put in that money. When we are adjusting the liquidity spread or for the treasury spread,
You're manipulating.
Then we are at a larger level. We are manipulating.
Did you pick level 2 or level 3? What was your conclusion at that time?
At that time, I remember it was we said level 2 because it was common domain. So we put it as level 2. It was all the bonds.
I would probably go. I got to research that one, but my instinct would be level 2 because everybody did the same thing, which means it's market consensus. And market consensus.
It's their value because it's not reflective of the investor sentiment at that point.
Not reflective of the current market.
Same thing happened in Karachi Stock Exchange also.
Market would include the investment.
Yeah. Well, I think.
Their perspective is not
If
being
I want to sell it at that point in time at 31st December,
You could not.
I cannot.
Because there is no orderly market available at that point in time.
Yeah.
Why? It is reflective of the investor sentiment.
Maybe they are looking at the point that whenever the orderly market would be available, then what would be the price?
I'll just give an example. The Karachi Stock Exchange over here is very volatile. Okay, so if any point in time you feel that the market is going south, a lot of investors, they come up that this is temporary and it should not be taken into account when you are doing the valuation because ultimately the value of this scrip is higher. This is just the sentiment of the market. So do you really feel that it's right to adjust? Well, I don't feel that it is right to adjust.
Well, the principles in IFRS are to value today. The principles in IFRS, it's a value today, and the principles in IFRS, it's a hypothetical number sometimes of how long it would take to match a buyer and a seller. So if you're adjusting the liquidity spread and no one ever buy at that price, that's not fair value. So then it's not. But my point is, if there's a consensus in the market, that would be level 2.
Consensus of the holders, not consensus by the buyers. It's just the people who are holding.
To manipulate.
They are coming into a consensus.
Then I would, if it wasn't in the public domain, then I would probably go for level 3.
But still you are okay with that? Saying that
No, I'm not okay with that. We say it's a fair value. No. Let's take a break first because it's tea's ready, and then we'll continue, all right?